Our next session is on capital markets. Is the Securities and Exchange Board of India doing enough to suitably protect the small investors? Well, let's find that out in our second session on capital markets, for which we have on our panel Shri Ajay Tyagi, Shri SK Mohanty, Shri Sunder R and Raman, and Shri PK Nagpal. Shri Ajay Tyagi is the former chairman of the Securities and Exchange Board of India. Before joining SEBI, he had a career spanning almost 33 years in the IAS, where he held several senior positions in the central and state governments. He also served as an additional secretary in the Department of Economic Affairs in the Union Finance Ministry, handling diverse areas like capital markets, investment, infrastructure financing, financial sector reforms, financial stability issues, and coins and currency. Shri SK Mohanty is a former whole-time member of the Securities and Exchange Board of India, a seasoned professional with over 34 years of experience in India's financial and regulatory sectors. Shri Mohanty was the director at the National Institute of Securities Markets and served as director of the Forward Markets Commission. With more than 2 decades in the Indian Revenue Service, including a tenure as Income Tax Commissioner, his expertise spans regulatory policy, governance, market risk, and international cooperation. Shri Sunder R and Raman is a former whole-time member of the Securities and Exchange Board of India. He was the Executive Director of Union Bank of India and Chairman and Managing Director of Canara Bank. Shri PK Nagpal is a former Executive Director of the Securities and Exchange Board of India. He also served as SEBI's Chief Vigilance Officer and has worked in roles across stock exchanges, investment banking, stockbroking, merchant banking, and equity research. The session will be moderated by Shri PK Nagpal. I request him to initiate the discussion by giving a brief view of the regulatory issues pertaining to the sector of capital markets.
Thank you.
Thank you.
Ladies and gentlemen, the theme of the today's topic is SEBI doing enough to suitably protect the interest of investors? They have chosen the words very carefully. All the panel members were part of SEBI till some time back. Now we are observing SEBI from outside. And I hope we shall be able to give you the objective analysis of this topic. As Mr. Tyagi mentioned that there are 3 main objectives of SEBI as per the preamble of SEBI Act: to protect the interest of investors in securities, number 2, development of security markets, and third is regulation of security markets. All the functions are complementary to each other. Now, SEBI had formulated rules and regulations in all the segments of security markets. How does SEBI regulate? How does SEBI achieve the objectives which we mentioned earlier? Number 1, all the intermediaries in the security markets, whether it is brokers, merchant bankers, mutual funds, alternative investment fund, credit rating agencies, infrastructure fund, venture capital fund, all are required to be registered with SEBI. Now, SEBI has specified rules and regulations, code of conduct for all the intermediaries, and SEBI has prescribed certain obligations, certain restrictions on the activities of the market intermediaries, so that they work in the interest of the investors. And apart from prescribing rules and regulations for the intermediaries, SEBI has also prescribed rules for primary market, secondary market, mutual funds, takeovers, and all the aspects of the security markets. If we start with the primary market, the main role of SEBI is that there should be adequate disclosures for the investors to take well-informed investment decisions. And nowadays, once the issue is over, public issue is over, listing is done within 3 days. If you know, 25 years back, in the Companies Act, there is a provision that listing can be done in 72 days. SEBI brought it down to 42 days first, then 21 days, then 12 days, then 6 days, and nowadays it is 3 days. Once the company is listed, then there is continuous disclosure requirements about the financial performance of the company, and if any major event takes place, they are required to disclose within a certain time period. Only disclosures don't protect the interest of investors. So therefore, SEBI has prescribed corporate governance norms. For example, there is a concept of independent director in case of listed companies. In case of stock exchanges, in case of mutual funds, in case of mutual funds, 2/3 trustee should be independent. In case of listed companies, 50% directors should be independent. Likewise, there is a concept of public interest directors in case of stock exchanges. Now, after that, likewise, SEBI has prescribed disclosure requirements, governance norms for all the market intermediaries and all segments of security markets. Now, after prescribing rules and regulations, it is very important that those are implemented effectively. So therefore, SEBI takes reports from the market intermediaries periodically. SEBI carries out inspections and investigations, and to check that there is no manipulation in the market, there is no insider trading and front running in the market, and so that the interest of the investors is protected as specified in the SEBI Act. Now, apart from inspections and after inspections and investigation, if SEBI finds any violation, then SEBI takes action. SEBI can impose monetary penalty, SEBI can suspend from trading, SEBI can cancel the certificate of registration of any intermediary, SEBI can prosecute in the court of law, and SEBI can also pass orders for disgorgement of any illegal gains. So this is the way SEBI has been regulating the market, and SEBI has been protecting the interest of investors. Now, you must have noted in the last 4 or 5 years, the number of investors has gone up substantially. The demat accounts in the security markets, which was only 4 crore 4 years back, now it is about more than 15 crore. Likewise, mutual fund assets under management, now it is 67 lakh crore. It was only 44 lakh crore last year. Last 4 years, it is more than doubled. And the demat account which I mentioned, it took 10 years to double the demat accounts from 2010 to 2020. But last 4 years, it has become more than 4 times. Now, when number of investors has been going up, the today topic is very relevant. That is SEBI doing enough to suitably protect the interest of investors? And I would request now former chairman of SEBI, Mr. Ajay Tyagi, to start and give his views on this topic.
Thank you, Mr. Nagpal, and good morning once again. To me, it appears, as if you're having a ex-SEBI board meeting here. Raghav has really invited all of the ex-people here. I won't speak much. I already spoken because my colleagues I'm sure, will want to give their views. Only one thing that investor protection is on top of the mind in SEBI. Now, to what extent investors have been protected, that is for the, they say, taste of the pudding is in its eating. But basically, the principles is disclosure regime and caveat emptor, as Raman said. Let the buyer be aware, and of course there are a lot of things: awareness generation and taking action. But ultimately, people have to learn on their own. And in a market which is booming in the last many years, especially post-COVID, and so it's only fear and greed actually play an important role. As you must have been seeing recently in futures and options market, so many people have been participating. SEBI report says that they lost almost 1.8 trillion rupees, 1,80,000 crore in the last 2 or 3 years itself. But still they participate because option premium is very small. Now they've come out with something. So it is on top of the mind of SEBI, as I said, as compared to the other two functions. Whether it is enough, it comes with the maturity of the market, and many a times people think that they are the wisest till they start losing money. And whatever you may try to issue notices, or you try to say be cautionary and all that, that has its own limitations. Thank you.
Thank you, Mr. Tyagi. I would like to add that, as Mr. Tyagi mentioned, that the people are still investing in the F&O market, and SEBI did a study that 93% of the individuals in the F&O market have been incurring losses. This study was published about a year back, and whenever any investor wants to trade in the F&O segment, first this study is shown to him. He says, I have read it, I know the conclusion. In spite of that, volume is at the same level which it was 1 year back. It means, in spite of knowing that the investors are losing money, they are still investing in the F&O market. Now I would request Mr. Raman to express his views on this topic.
I would just deal with a very general philosophy of how to protect small investors. First, everyone thinks he is the wisest person. For instance, F&O, you tell a person, this is fire, don't go there. No, I can handle the fire, and he would like to go. There are challenges for a regulator, whether the youngsters should be allowed to go or not allowed to go. If allowed to go, what are the framework which we can have? That is a big challenge from a regulatory perspective. I am reminded of that case of Zomato. When the valuation was increasing, all the private equity fellows were saying, okay, this valuation has gone from 1 billion, 2 billion, 3 billion, 4 billion. Sky is the limit. And then there were a lot of complaints to SEBI or everybody else in society. The retail investors are being prevented from having the benefit of extraordinary jumps in valuation in the tech sector. Why should retail investors not be allowed to enjoy what only moneyed fellows and big fellows are doing? Whether it was right or wrong, that was a big challenge for SEBI, whether we should allow or not allow. What happened, of course, Zomato, finally, we said, okay, SEBI, of course, I was no longer in SEBI, but SEBI allowed, okay, Zomato to go ahead, the public issue, and the retail participation was also allowed. Then, of course, in the immediate aftermath, it tanked. So 60% down from the issued price. So again, there is a clamor. Why did SEBI allow? On what basis this valuation is allowed, and what are the assets which Zomato had? There was an ulta question earlier. How does it matter to you whether assets are there or not? It is a business model, and that's why it is increasing in value, and you are depriving retail investors from making money. And then when you allow and something else happens, again SEBI is to blame. So the regulatory role is philosophically itself very tough. When do you allow access and not allow access? And somebody may say tomorrow, now SEBI has clamped down on the F&O to the retail segment. And then now suddenly it's now being mentioned that the liquidity is gone or the turnover is going to drop by 30-40%. What is going to be the impact on the market? How does it matter if somebody is losing money? After all, I should be allowed to take risk if I want to take risk. That is another philosophy. I am not a child anymore. I know what I am doing, so please allow me to do. Loss? No problem. I am willing to take loss. I mean, this again leads me to another subject which is called, accredited investor. That was a great subject during our time. Accredited investor, okay, that is, there are some people who want to have investment risks. I want to take risks. So if I have that attitude and aptitude, then I should be allowed to take the risk. So we said, but then again, retail, if somebody goes and burns his hands, again, regulator, what did you do? Your job you did not do well. So what we decided was we will have a category of people known as accredited investors who have a sufficient minimum net worth, etc., and minimum exposure to the market, etc., and then, okay, we allow him to take the risk if he wants to take the risk. So this again, so I just wanted to bring this particular general point into discussion, the philosophical aspect of when you regulate, what you regulate, what access you regulate, when do you regulate, all tough questions, but has to be answered. Thank you.
Thank you, Mr. Raman. He has pointed out very well that ultimately SEBI had to strike a balance, and when any new issue is IPO is listed at a very high price, and all the investors want allotment. And for the information of audience, I shall like to inform you that in the SEBI regulations, minimum 25% public offer should be there, and if the company has a profitability track record and certain net worth compliance requirements, and in that case SEBI has prescribed that minimum 35% of the public offer should be reserved for the retail investors, and the retail investor has been defined as where the application size is 2 lakhs rupees. And if the company doesn't comply with the requirement of profitability and net worth, etc., in that case the issue should be through the book building process. It means 75% should be invested by the qualified institutional buyers like mutual funds, insurance companies, like that. And so this is the way SEBI has prescribed the certain reservation for the retail investor in the at the time of IPO. Now I would request Mr. Mohanty to express his views on this today's topic for discussion.
First of all, good morning to all of you. And I'll straightway come to the last sentence of my observation, that is going to be nothing was enough. It will never be enough, and it is not enough that SEBI has been doing or is going to do ever to protect the interest of the retail investors, small investors. Because the market is constantly evolving, and the micro and macro behavior of the investors also are going to constantly change. So therefore, the regulator will be always on the toes to keep reforming, making regulations, and at the same time keep taking measures for effective supervision and monitoring of the market. So that will be always a work in progress, and nobody can ever say chairman and the team leadership will come and go one after another. But never, even after 25 years, we can sit here and discuss, and nobody can ever say that SEBI has done enough. So having said so, if just coming to the moot question, whether enough has been done or anything has been done and what has been done, we should know what are the basic pain points where the investor needs protection. So like each of us, maybe for example, I have all along been a FD or postal saving man. Suddenly I get little bit of literate about capital market and start entering into the market. So there are two ways to enter into the market, directly or indirectly. If I enter indirectly, I will indirectly enter through pooled arrangements like mutual funds, alternative investment funds, etc. If I want to enter directly, I will definitely go as an investor or a trader. So if I am an investor, means I want to stay invested in the company for some time, for few months or few years also. And if I want to do trading, I don't believe in blocking my money in one particular company. I'll go to the market every day and start trading, buy, sell, buy, sell. It could be intraday trading, or it can be a short-term rolling basis. I'll split 2-3 days BT, ST, STBT they call, so we can buy, sell. Or I can also enter into, I'm so fond of risk. My risk appetite is so much that I don't mind getting into the casino called F&O market. I can go there and also play. So like my young brothers and sisters sitting over there in the corner, I think they may be having a lot of risk appetite. They may do that. So where are the pain points coming from? Like if I am an investor, I am staying invested in a company, and I may be thinking that, okay, I have invested Reliance, I'm just or any other big company, blue chip company, fine, I can sell whenever. But when I stay invested, anything can happen. There could be two categories of events that can happen. One is market facing, the other one is governance facing. There could be market disturbance in the script of the company. There could be governance disturbance in the script of the company. And market disturbance could also be in the form of, let's say, price volume manipulation or front running or insider trading. So I'm an investor, gullible investor. Somebody can come and play with the script of the company and just do all these market manipulations. So at the same time, there could be governance problem also. I don't know. They are saying this share price is 100 rupees, but after 3-4 quarters, suddenly I find 40% drastic fall in the market price. Because what has happened? In the meantime, I found the management, the CFO, or somebody has siphoned or misappropriated. There's a huge governance problem in the company. So by staying invested doesn't mean that I'm not getting exposed to risks. There are two types of risk: governance risk and market risk. There again, SEBI's role comes for effective supervision and monitoring, and for front running we have prevention of fraudulent trade practices regulation, and effective monitoring and supervision in terms of taking enforcement actions. To the extent of making raids, search and seizure actions also SEBI has indulged in of late in over last 3-4 years. It has really increased these search and seizures in front running cases. Earlier front running cases used to be very simple. Somebody is trying to put some good big amount of order. I come to know, I go and just race ahead of him and take some position and try to make money. Now front running is artificially being created out of nothing. There is a group of people hoping it's a Telegram channel, and somebody is just misleading people that these 3-4 scripts you start buying and people are following and buying and price is increasing. I have taken position earlier, so I am making money out of coming out of it. And governance risk also, suddenly I find my money 100 rupees has become 60 rupees. There also SEBI has two types of investigation. One is market facing investigation, IBD. The other one is corporate finance fraud investigation department. When Sir was there during his tenure only it was created. So it has been effectively dealing with them. But they are all part of effective supervision and monitoring. Similarly, if I don't want to be investor, remain invested in a company, I just want to be a trader, there also SEBI's responsibility comes to protect, to create a robust mechanism in a manner that I trade safely. My money is not misappropriated by the broker. My collaterals are safe. My securities are safe. My fund is safe. So you must have heard SEBI coming out with so many reforms, T+1, T+0. Then also replace mechanism again. That is something was done during Mr. Tyagi's tenure. Then now we are also trying to create a mechanism through which ASBA-like features can be introduced in secondary market. Your money will stay in your account as long as you are not buying something. Broker will not touch your money except for brokerage. So these kind of measures have been taken. These kind of measures will be taken because if the violators wants to violate, they can find some ways here and there, and it's not going to stop at all. So this is part of a life of an investor or a trader. Again, if I am getting into F&O also, my Meri Marji, as Mr. Raman pointed out, his thinking is smart, he can get in. We can't stop him. But we have to give him a robust platform where he shouldn't lose money unnecessarily. Let him lose money because of his own follies. So SEBI has been giving this kind of atmosphere, ambience, by creating different channels, by giving new products, by creating some kind of a robust platform and settlement and guaranteed settlement, and all these things factor into a cohesive kind of institutional build-up of reforms in a manner that the interests of the retail investor is protected. So they are going on and on. You must have got to know so many things have been done over last several years, and of late, because of technology intervention, a lot of things have happened, including in trace of the bond market. Also, retail investors have been taken care of. Small products have been given like REITs, InvITs, mutual fund light, and so on and so forth. And new institutions have been built up like limited purpose clearing corporation, online bond platform, and execution only platform for mutual funds. So everything is in a work in progress. The thing is that at the end of the day, what SEBI has been telling, that it is the investor who should know his rights and duties and liabilities and risks also. So an informed investor is always the best investor that we would like to have. Ideally, we would like to have the entire universe of investors to be accredited investors, who is well literate and capable enough to take care of himself, which is an ideal scenario, which is not going to happen. And as long as that scenario is not going to happen, the regulatory responsibility will continue. Thank you.
Thank you, Mr. Mohanty. I shall just inform you that SEBI has well-defined grievance redressal mechanism, and where investors can lodge a complaint, and in a time-bound manner it is redressed. And in the stock exchanges also, there is a provision of arbitration, and the investor protection fund, if any broker is declared a defaulter, in that case, investor can be compensated out of investor protection fund. Now I would request.
I think, let's end.
Yes.
I mean, please, we should give time for question.
Yes.
You are asking question.
I think I have the permission to ask a question of my batchmate.
Yeah, you sir, you have all the right.
So as former chairman of SEBI, what I would like to know is, see, this investor space is a huge space, but there always will be information asymmetry.
Yeah.
No investor can claim to know what is happening behind. There's a lot that is happening behind the scenes, as Mr. Mohanty has just pointed out, where people are trying to play the market. Now, SEBI therefore has a very strong proactive role because, individual disparate investors all over the country or across the globe will never be able to know what is happening behind the scenes, but SEBI perhaps will be in a better position to not always. So in this proactive role, there are problems, there are issues. How do you kind of negotiate this this very delicate space or very delicate situation?
That goes to the crux of the whole thing, and there's constant and continuous information asymmetry between the issuer and the investor. And in SEBI for 5 years I was there, every day is a new day, and it's not that you can learn from what happened yesterday. And over a period of time, efforts have been made by SEBI and market infrastructure institutions, that is exchange and depositories and clearing corporations, to strengthen and to stay ahead of fraudsters. But there are limitations with the change, with the technology playing an important role. SEBI also has started using artificial intelligence and machine learning in terms of seeing what is the pattern of trading and what are the possibilities. So in addition to issuing changes in regulations in terms of say PFUTP, which is on the fraud side, or PIT, insider trading or front running, also use of technology to see that if there is some trading which is which is suspicious, to quickly take action. Now, proactive part has both sides, as Mr. Raman also was trying to say, that proactive, if you are not proactive, there is a problem. You become too proactive, that also is a problem. And in a country like India, where courts actually come down heavily on you, on the regulator, apart from the investors and other lobbies, Like I remember one mutual fund case, Franklin Templeton, in the COVID times, and suddenly they had to stop some schemes for 30,000 crores. So they said why SEBI was not very active. And then 4 5 high courts, and then ultimately Supreme Court and all. So what I mean to say is that to find a regulatory balance to be when to be active and when not to be active is something which cannot be taught in any management school or anywhere. And that is the thing which one learns, how to react or not to react, and if you act to see the end game, how it will end, and not really, if you don't see that, then it can be very, very chaotic. And a market in the SEBI type of job, it is anyway chaotic. In fact, world over, even if you see in US, SEC and all also, is a capital market is a chaotic job. So you can't really escape. You can't say that I'll do something proactively and nothing will happen. That is just not possible. Yeah, so it's a difficult balance.
When the new issues used to come, IPOs, there used to be premiums used to be decided by SEBI. So I think that's an era long gone back. But now we find, not in SEBI, maybe at the CCI times. Yeah. But now what we find is that there's so much euphoria, and many of the issues which come with so much premium, which look very unrealistic. We saw that one automobile dealership with 3, I think, showrooms. A huge premium was being charged, and the issue was also subscribed. So is there any thinking in SEBI that some control should be there on the premium, and especially like when you approve a, say, IPO, do you have any look at it that's unrealistic premium, or you just approve it?
I think you want to speak.
Okay. See, nowadays premium is not decided by SEBI, and once the CCI Act was repealed in 1992, there has been a free pricing. What SEBI had done, introduced the concept of book building. It means either 50% in case of profit-making company and 75% in case of other companies should be subscribed by the large investors, like mutual funds, insurance companies, venture capital funds. But SEBI does not decide the premium. Company decides in consultation with the merchant banker. And you mentioned about some public issue. It is in the SME sector. What SEBI had done, SEBI had prescribed the minimum application size of 1 lakh rupees, unlike other public issues, so that small investors should not come in this market. That is what SEBI had done.
So I just want to add a couple of things. SEBI doesn't get into valuation of the company. That is none of our business. It is only merchant banker, and they decide how much premium they have to charge. The only thing SEBI has done over the years, based on our learnings, especially after the Paytm thing and all, that the key performance indicators have to be mentioned, particularly those key performance indicators which they have pitched before the earlier investors from whom they had raised money through various rounds of fundraising. So that has to be disclosed, and few ratios have to be disclosed in a manner the investor will be in a fair enough position to understand what is going to be the valuation of the company, enterprise value.
Only one thing to add, Arun. There are two things where there is more of a distortion. One is the SME IPOs, and there again ease of doing business, that for SME IPOs it is approved by the exchanges and not by SEBI, the DRHP. Just to have, again, ease of doing business and protection, that balancing is also continuously there. Secondly is for loss-making companies. What happened in 2021, many of these growth companies or tech companies which are loss-making, and that time they wish to get listed only in US and all. They said the framework here is not there. That was introduced with a lot of precautions, that 75% has to be institutional investment, and the individual investment, retail investment was reduced to 10%. And then later on, as Mr. Mohanty said, KPIs and all. So this problem, what you are saying, is either in SME or the new tech, where one has to be careful. Approving valuation though will be now, that is. And also now the merchant bankers in the advertisement have to say, then the last so many issues which they have dealt, whether on the listing day there was rise or fall. So they have to also show their performance. So it's a question build some reputational risk for the merchant bankers also. It's a mix of that being tried. Thank you.
Yeah, good morning. Overwhelmed to see this distinguished panel. So, and it was very enlightening session. Although there are so many questions, but we can take it offline related to SMEs, algo trading, F&Os, and but my question, direct question right now is a kind of a progressive question that in comparison to now we all are seeing the kind of liquidity, the kind of finalizations of savings which is happening in our capital markets. So, and about 20,000 crore to 25,000 crore every month SIPs are flowing in. So, in comparison to developed markets, for say, let's talk of US, in comparison to that, what steps our capital market regulator is taking to make our market more flexible, more avenues to option, because there are so many products, so many flexibilities there in the overseas developed markets, and we are highly regulated. I also of the view that a lot of regulations are now being opened now, as just Mr. Tyagi has mentioned that loss-making companies have recently been allowed and all. But I just want to hear out what is the outlook over from that aspect, from the progress and the growth aspects. Yeah.
So you see, like it was said, the demat accounts in 2019-20 were 4 crores. Now they are over 17 crore. In terms of the adult population participating in capital markets, which used to be, say, 5 years back 6-7%, is now 9%. You compare with US, there it is 60%, but it's not comparable in terms of per capita income itself. Then even mutual fund, their size, AUM as compared to GDP is 18%, in US it is 150%. So everything we try to compare with the West, but things are not really comparable in terms of potential, in terms of per capita income, in terms of where we are. So it is actually gradually only it can be done. That's the only way. Otherwise, like we allowed in when REITs and InvITs, Mr. Mohanty said regulations were framed in 2014. Till 2017, there was not a single issue. So you have to constantly be in touch and back and forth with the industry, and start with the conservative thing and then actually improve. If you suddenly let it go, then there are problems, and then the repercussions are very heavy. So I think gradual approach is the right thing, and that's how you see the sleuth of regulations coming. Sometimes very difficult to comprehend, but that's the way to go.